His head's big.
So Tyler is the presenter right now. So there's you and Tyler right there.
Okay.
You should be able to talk to him.
Holler?
Hey,
No.
how are you guys doing?
I'm good. How are you?
Doing well. I thought we were going to get bumped till 11 o'clock, but we were on early.
No,
That's
we're
good.
not. They were done. So.
Okay.
You can squish it.
Right.
No.
I just clicked on the share my screen.
Okay.
Are you seeing that deliver the difference?
Yes, I'm seeing it.
Okay. All right. Go.
Should be good to go. Okay. Okay. 8 minutes. So. Just hang tight for a minute. Was it really thick here or worse?
I didn't know how much we got here.
We got a lot. It came like a torrential downpour on Friday. Yeah. So, anyway.
Well, enjoy.
You too. Miss you. All right, we should be ready to go very shortly.
Okay. Is Tim going to do the intro?
I'm going to do the intro.
Okay. All right.
Is there something in particular you want me to say?
No, I guess usually Tim talks up Index Universal Life a little bit before, just to build it up as to why you'd want to consider selling IUL. But, you can do whatever you want, really, because that's really what the whole presentation is about, is Indexed Universal Life. So
Okay.
it doesn't have to be very long.
Yeah, it's not going to be because I don't know anything about it.
All right.
All right. Got about 3 minutes.
Yep, that's what I'm showing too.
Okay. I kept looking at the computer screen and it's way faster. It's 3 minutes faster, so it says 11 o'clock right now. But then I remembered, oh, that's not the right time. That's Gordon marketing time.
Yeah, well, I'm showing 2 minutes to now, so a couple minutes.
Yeah. Okay, I'm going to mute my line and do some. All right, we'll get started. Can you hear me?
I can.
Okay. Good morning, everyone. This is Elisha, Tim's trusty assistant, with you guys this morning. While Tim's in training in Sacramento for the FEBC program, we have Aller Hawk from North American with us today. He is going to share with you the basics of Indexed Universal Life Insurance. So I'll hand it over to you, Aller.
All right, I appreciate that. Thank you. It's a pleasure to be here again with the Gordon Marketing folks, our partner agency there in Indiana, but obviously covering the entire country. So anyway, today we're going to talk about Indexed Universal Life and just kind of covering some of the basics. But first of all, let me just talk about why you'd want to consider even proposing an indexed plan for your clients. Obviously, it's a lot easier probably to sell a term or a GUL concept. Index Universal Life gets a little more complicated because we have a cash value component on the product as well, which can, sometimes create some confusion with the client as to how they can use that. The idea of what we're going to talk about today is how to perhaps get over some of those confusing things on Universal Life, and how you can actually use those advantages of the cash value for your client's benefit. There's a lot of things you can do with that cash value component. One of the most popular ones is using it for supplementing their retirement income via cash-free distributions from the policy, tax-free, I should say, tax-free distributions from the policy. They can use them for college funding, helping their children fund their college educations. They can use them for maybe any unexpected emergencies that they might have down the road. Or perhaps they just want to use it for, maybe putting a down payment on a second home or something like that. There's all kinds of opportunities that they can utilize with the Index Universal Life plans, and being that the IUL products are designed to create significant cash value accumulations, that's really one of the big advantages. The other thing that generally pops up over and above the general sale of term insurance is when you get into permanent insurance plans, you also get what we call accelerated death benefit riders. And those are advantages to the client from the perspective of using not only just the cash value component for living benefits, but also having access to the death benefits of the contract prior to the client's death. Accelerated benefits are used for either terminal illness, for chronic illness, or for critical illness needs. So again, we're going to cover those in a little bit more detail as we go through the presentation today. But again, just be thinking of that as an additional opportunity to bring to your clients some additional products with some additional benefits that they can utilize for their own purposes down the road. And here's just the compliance page. I'll give everybody just about 30 minutes to read through that. Anyway, today we're going to do just kind of a high-level overview of Index Universal Life, and just feel free to, as you're going through, if you have any questions, take notes or type them into the questions section of the toolbar there, and we can try and answer those at the end of the presentation. From an agenda standpoint, what we're going to talk about today is, first of all, defining IUL, talking about some IUL features, and then specifically we're going to go into the North American product IULs and as to why you'd want to propose the North American product for your clients. So let's get started by talking about the definition of Indexed Universal Life. So what is Indexed Universal Life? It's very similar to traditional fixed universal life products in that it has a guaranteed account, and it also has an indexed account. It also has the flexibility in death benefit and premium that you're used to in traditional universal life products. And then you can also use a fixed account in an IUL chassis and kind of make it perform very much like a traditional universal life product if you want to do it that way as well. Obviously, the advantages of using the indexed accounts to garner higher yields, higher returns on the cash value is the whole idea of what most people are utilizing the IUL for. The difference is that the indexed UL has what we call the indexed account, and basically it's saying that it credits interest differently than a traditional fixed universal life account. And what we do is we look at a particular index, and if we purchase what we call an option on that index, we can garner the gains in that movement of the index without actually investing into the marketplace. So that's one of the big advantages, again, that the client, neither the client nor North American actually invest directly into the market. We're actually just utilizing the movement of the outside index as the measuring gauge to how we credit the returns on the product. So if the index goes down, we credit a 0 return on that index segment. for that client. If the index goes up, we credit the gains in that index up to a cap rate and lock those gains in on an annual return basis. So again, upside potential without the downside risk. That's one of the big advantages of the indexed product. And as I mentioned, the client never invests directly into the market, so they're never putting their money at risk in the market. Where does IUL fit in the marketplace? I think it kind of fits somewhere in between a fixed or traditional universal life product and a variable universal life product. So let's take a look at this chart here and show how under a fixed UL, the growth of the product, of the cash value, is at a stated interest rate, and that interest rate is based on the company's overall general portfolio performance. The IUL product, the returns are based on the performance of an outside index. So as that index performs, so does the credit to the cash value in the indexed chassis. If we look at a variable product, the variable products are a direct participation in the market. So they're performing at exactly whatever that selection of the in the market that the client has chosen is going to do. The next one is the minimum rate. IULs are based on a stated minimum interest rate. They can't go less than that. And usually in today's marketplace, that's probably around anywhere from 1.5% to probably 3%, whatever the basic product design is. The IUL has a minimum rate of 0%. Again, we said it never participates in the downside, so if the index is down, the IUL product will credit 0 for that particular index segment. On a variable product, we have no minimum, and it can lose money because if they're directly participating in the market, if that investment that they make into the market actually goes down, their cash value can actually go down. There's no floor on the variable product. Both the fixed and the index products are called non-registered products, meaning you do not have to have a securities license to sell either one of those, just a life insurance license. The variable products are registered products, and that means you do have to have a securities license to sell them. So that gives you kind of a feel for where the IUL fits kind of in between those two products in the marketplace. And then why would a client be looking at an IUL product versus perhaps some of the other options in the marketplace today? Again, the VUL, if the client is a participant already in a VUL product, they're probably used to those roller coaster rides. You'll have some years that are very, very good, and you'll have high growth in your cash value, but then you'll also have years that it's negative, and you'll see your cash value actually going down. And what we find many times is clients, after a while, become tired of the roller coaster and want something a little bit more stable. And that's where an IUL product can really be advantageous for that type of a client. There's also whole life products out there, but whole life products can be expensive as far as the pricing. They have very good, strong guarantees in the whole life products, but the premium that you spend for them can be very high. And the upside potential on a whole life is pretty much limited. It can't be near as upside potential as you're going to find in an IUL product. And then today's low interest rate environment that we've been mired in for a number of years is very damaging to traditional universal life products, which are very interest sensitive. And when interest rates were higher, regular fixed universal life products were performing very, very well. But now that we've been mired in this low interest rate environment, it can be a problem, and many times companies have come back to the clients and asked for significantly higher premiums to carry the contract out, and that's because of the low interest rate environment. You don't see that same volatility that you have in the IUL market space. Benefits to the client: high growth potential, meaning the opportunity to see high cash value growth with their IUL product. Potentially lower premiums. And why do I say potentially lower premiums? Because if we're proposing higher cash value accumulations, that means that we actually can price in a lower cost of insurance on the opposite end of the spectrum for the cost of the actual insurance part of it. So we can actually show potentially lower premiums on an IUL than we can on a traditional fixed universal life product. And then minimum interest rate guaranteed. As we have already mentioned, the annual minimum on an index segment is 0%. You can never be showing a negative on an IUL product from that perspective. But we also have a minimum account value calculation within our products with North American at 3%. And basically what it means is that every 8 years we will look back on the index account during that 8-year time period, and if it is performing at anything less than 3%, we will make the client, we will true them up basically to the 3% minimum account value calculation. And when you look at our illustration software, if you've had a chance to ever do that, you will actually see that we're actually showing 3% as the minimum guaranteed rate on our illustration software because of that minimum account value calculation. It doesn't necessarily mean that we still don't have an annual 0% return, but it does mean that over 8 years you will never get less than the 3% return on your index product. So again, when you're comparing that to a traditional fixed universal life product, many of those are probably right around that 3% rate today, and so that's kind of the worst case scenario on an IUL product. So be aware that the low end of the spectrum is probably where the traditional IULs or traditional ULs are today, but the upside potential is for much far greater returns than that. So from a client, what kind of client would be interested in a IUL? Obviously, first and foremost, we want to make sure that the client does have a need for the death benefit, and most clients do have a need for some death benefit. And once you complete a fact finder to go through a needs analysis with your client, you'll probably find that they have far less insurance in place than they have a need for that coverage. So first of all, make sure that they do have a need for the death benefit. Secondarily, it's a client that wants flexibility. Now, that's going to be flexibility in their face amount of their coverage and flexibility in the insurance protection period, how long they want that coverage in place for. Or even it could be they want to keep the coverage all the way for their entire lifetime. I mean, again, you can design these products to meet whatever the client's needs are going to be. It could also be flexibility in their premium payments, because many times clients are looking at how much they can afford to put towards the life insurance today, but they may have the opportunity or the ability to put more money in the future. So keep that in mind, that the flexibility of the premium is also a very key component in the IUL marketplace. And another aspect for the clients typically looking for an IUL are those that are looking for a good return without putting their money at risk. So I think that category really sums up the typical client of an IUL. They want the potential upside of that market growth, but they want to be protected from the downside risk. And those could be either young or old clients. They could be wealthy clients or middle-class clients. You know, many of the clients out there that you're probably talking to on a daily basis are clients that would potentially look very favorably on an IUL if given the opportunity to take a look at the product. Let's look at some IUL features and show you what makes it different from a regular universal life plan. First of all, we talked about this, we're using index options. Basically, we're saying we're selecting an outside index, and here's a number of them. Obviously, North American even has more than this as far as options that you can select from. But you're generally looking at some financial index, as how does the S&P or the Dow performing? How is the NASDAQ performing? Those are all pretty much large cap indexes. We also have selections in the mid cap range, and we have indexes in the small cap range. So the client has the opportunity to select amongst all those different indexes and allocate their premiums towards those as they see fit. There's also the option of a fixed account, and as I mentioned, if you do put your money 100% into the fixed account, an IUL will perform very much like a traditional fixed product. But again, the worst that with that minimum account value calculation we talked about that an IUL can do is probably what traditional fixed accounts are doing in today's marketplace. So many times we do allow a client to put 100% of their allocation towards their index selections and not have to put anything into the fixed account. And again, that's where your opportunity for the higher returns are in the index selections anyway. So as long as your total allocation ends up adding up to 100%, you can select how you want to allocate amongst the different index choices. Let's talk about buckets, because this is a little different feature of an IUL as well, in that each premium payment is handled separately. And each allocation would be handled separately too. If you selected multiple indexes, you could actually have one premium payment being spread out amongst 2 or 3 maybe different index selections, and each one of those is going to be its own bucket. And what do I mean by buckets? Basically, every time the client pays us a premium, we will allocate that to their individual bucket, meaning that index selection will have a start date and an end date, usually 1 year later, and we will look at how that particular index performed during that 1 year time period, and then credit the interest at the end of that time period. So again, if a client is paying a monthly premium, they could have 12 separate buckets at the end of the year, each one with its own start date and end date. And that's kind of the bucket theory of the IUL products. Here's a quick example of how the buckets work. If we did a semi-annual premium, maybe 2 premium payments during the year, and we're going to use the annual point-to-point method using the S&P index. So the first bucket, let's assume it was on January 1st of 2014. That bucket is going to run until January 1st of 2015. Let's assume the S&P was at 1,000 when they started on January 1st of 2014. It rose to 1,100 by January of 2015. That was a 10% gain. As that index moved up 10%, at the January 1st of 2015, we're going to credit 10% gain on that first bucket for that client. Now, the client's paying a semi-annual premium, so on July 1st, they pay their second premium into the contract. That bucket starts January 1 of 2014 and runs to July 1 of 2014, runs to July 1 of 2015. Let's assume that it started on July 1st at 1,050. It rose to 11,0250 by July of 2015. That was a 5% gain or movement in that particular index. So that second bucket got 5% return for that particular premium amount that was allocated to that bucket. So you can kind of see how each bucket is calculated separately with each premium payment and each allocation to whatever index the client selected. I talked about the point-to-point method. And again, this is a method where we actually look at only 2 points in time for that particular bucket. We look at the first point in time when we receive the premium. That starts the annual clock ticking. At the end of the index segment, point B in this example, is the 365th day after they put the money into that index selection, and we look at what did that index do during that time period. If the index went up, we lock in the gains. If the index went down, we credit 0 for that particular bucket. Now, in addition to the annual point-to-point, we can actually have things called caps as to the upside potential and participation rates, which say how much of that movement of the index do we participate in. With our North American company products, our participation rate on the annual point-to-points is locked in. It's guaranteed at 100%. So there's no up or down movement based on the participation rate. But the cap rate is subject to how much we have for an options budget for that particular option that the client is purchasing. So the cap rate in our S&P 500 example with our product would be like our builder product is 13%. Meaning if the index rose, let's say 15% during this 1-year time period, the client would participate in the gains up to the 13% cap. So the additional 2% is not credited based on the fact that our cap rate is set at 13% in this particular example. So let's take a look at another method of calculating. We looked at the annual point-to-point. That only looks at 2 points in time. What happens in the situation where you have maybe an index that rises for 9 or 10 months during the year, and then the last 2 or 3 months during the year, it falls off? And so in that annual point-to-point scenario, we only looked at the 2 points in time, the beginning value and the ending value. We didn't look at anything in between. The averaging method actually does take into consideration all those points in time in between the beginning value and the ending value, and it averages them out over the annual time period. Again, this is going to be subject to the cap and participation rates, and the cap and par rates are usually lower on the averaging than they are on the annual point-to-point. So averaging is a method that takes into consideration all those individual movements of the index over the annual point-to-point method. So we take the index growth and we take it times the participation rate, and that equals the credited rate, which again could possibly be capped. So if the credited rate were higher than the cap rate, the client will receive all the returns up to that cap rate, but nothing in excess of that. Some people say, well, then the company keeps the amount that is credited above that. No, that's not true. We price our options to be cost neutral to us. So if we have an options budget that we can buy a 13% cap, there's no additional gains to the company from that excess return on the index. That would be the option seller that might return those additional gains to them. But as far as we as a carrier, we price our options to be cost neutral. All right, let's talk really quickly here. We did talk about the cap and the floor rate at 0%. What we didn't really talk about was the annual reset. And the annual reset is really, I think, a valuable feature in an IUL product, in that once you lock in a gain at the end of a bucket segment, you no longer can lose money on that index segment. It can, based on the index returns in the future. So again, once you lock in a gain for that bucket segment, we kind of build a floor underneath it and say future returns in the index segments, future losses or downward movement in the index segments can no longer take away the gains that have already been credited to that segment. And again, we have a nice little piece in our marketing toolkit that kind of shows how the annual reset and building that floor underneath that really can help the client build their cash value over time. Here's a couple of quick examples of how IUL index crediting can work in different scenarios. If we look at the first one here, we have an index growth rate of 7%, a participation rate at 100%. That means the crediting rate was 7% for that segment, and that's well within the cap and floor range, so the final crediting rate for that bucket was 7%. The next example is one at 16% index growth. Again, 100% participation, meaning a 16% crediting rate, and that is above the cap rate at 13%. So the final crediting rate for that index bucket is 13%. The third example is a averaging scenario where we have a lower participation rate. So we have an 18% index growth. We have a participation rate at 55%, meaning the crediting rate is 9.9%. And this particular method of crediting doesn't have a cap rate. So the 0% floor still applies. So the 9.9 is the final crediting rate for that bucket segment. The last one we're going to look at is a negative index growth. So the index was down in that particular segment, 11%. Again, at 100% participation, that was a negative 11% crediting rate. That is below the floor rate at 0, so that particular bucket received 0% crediting. So again, hopefully that gives you a feel for a couple different scenarios on how the IUL can function for your clients. All right, let's take a quick look at the North American products when I think we've got a very, I would call them client-friendly designed IUL product. And so let's talk about some of the features that make it very client-friendly. First of all, competitive performance. I think we have a product that is, I mean, we look at our products on a monthly basis against all of our competitor products, and we know we have a very competitive product. So we are, especially in the retirement supplement marketplace, if you're looking for growing cash to take money out in retirement, we have almost always are number 1 or number 2 in that segment. So very competitive performance. Variable interest rate loans. This is the time when the client's looking to actually take money out of their contract. There's a way you can do it through variable interest rate loans that allows the amount that's taken out of the contract to still be participating, if you will, in the index gains that are being accrued within the contract. So the variable interest rate loans can actually have a positive return instead of a cost to the client. So that's a very valuable feature to have for the clients. And our variable interest rate loan is actually capped at 6%. So the client is protected over the long haul of knowing that that variable interest rate loan is not going to be going too high and wiping out any potential leverage that they might have with that variable rate loan. We talked about accelerated death benefits, but I think here we're going to talk a little bit more detail about them. Again, if you have a terminal illness, a chronic illness, or a critical illness, the client has the opportunity to accelerate not only just their cash value out of their contract, but death benefits as well. They can accelerate anywhere from 5 to 24% for chronic illness on an annual basis. So again, if they have costs associated with their chronic illness that they need to reach into their life insurance policy and pull some of those accelerated benefits out of there, they actually have that opportunity. And this can be a very, I'm going to say, a lot of people call it long-term care, but the chronic illness benefits are the same definition basically for triggering the benefit as any long-term care policy would be, meaning 2 out of the 6 activities of daily living or a severe cognitive impairment. Now, being that it's the same triggering mechanism to accelerate the benefits, it doesn't necessarily mean that it is long-term care. But many times it is a adjunct or an additional benefit that you can have to create another pool of money to pay for some of those benefits that you're going to need to provide for your long-term care needs. Daily sweeps. This is an advantage that only North American has. We're the only company in the IUL market space that actually does what we call daily sweeps. Why is that important? Or what is it actually? Let's talk about that first. Daily sweeps are whenever a client pays us a premium, either that day or the following business day that the options market is open, we move the money into their index selection on a daily basis. So we get the money into the account, the index account, much sooner than any other company in the industry. Everybody else is either bi-monthly, monthly, quarterly. There's even one company that does it only annually. So be aware that when you're selling IUL products, there are different design features out there. And again, I think the North American product design is a very consumer-friendly design. Let's look at a few more features. A lot of different index selection options. Again, we mentioned that North American has a lot of different options available as far as the indexes that you choose from and averaging or annual point-to-points. We actually have 13 different options that the client can select from. So again, they can select the one that's going to best meet what they feel is going to be their best opportunity for growth in their product. We have guideline premium or cash value accumulation tests available in all of our product designs as well. Now, I'm going to say 95% of the sales we probably do are guideline premium sales, because the guideline premium actually is the test that allows for the best cash accumulation. But the CVAT, the cash value accumulation test, there are certain times when the CVAT actually does outperform the guideline premium test, and that's usually in an area we call the smart money sale, and that's a whole nother presentation to talk about that. But just bear in mind that we do have both options available to create the best accumulations for your client. North American does not require any money applied into the fixed account. So you can allocate 100% of your premium dollars towards the index or indexes of your choice. If you want to put an allocation in the fixed account, you certainly have that opportunity, but you do not, it is not required. Competitive compensation, obviously, we're all in this business to earn a living and make money, and North American has a very attractive compensation built into our IUL products as well. A couple last features are overloan protection. When we're talking IULs and building up cash and growing cash to use in the future, we want to have a protection based on the backside to say we don't want to overloan the product to cause it to lapse out. And so North American has a built-in overloan protection feature that allows that client to make sure that they're not going to overloan their contract and cause it to inadvertently lapse down the road. We also have a unique feature called the protected death benefit feature. And if you've ever had a chance to run these illustrations and start looking at some income scenarios, you're going to notice that once the client starts taking the income, their cash value account starts going down, their cash surrender value begins going down when they take the income, but also their death benefit will start reducing when they're taking those distributions. Well, let's assume that the client has that starts seeing their death benefit dropping and starts saying, well, I'm kind of worried about that because I want to make sure I never get less than a set amount of death benefit. They can actually carve out, if you will, that portion of their death benefit and set it aside as a paid-up portion of their death benefit and still continue to take their distributions on the remaining portion. So protected death benefit is a downstream benefit. It's not something the client's going to see the benefit in today. But once they start taking those income distributions, that may be something that's a very valuable benefit to them. Interest rate bonus. We have interest rate bonuses on our contracts in future years. And those interest rate bonuses are contractually guaranteed on the index accounts. So it's not something that we've just built into our software and we just say, yeah, we think we're going to apply that bonus in the future. No, it's actually contractually guaranteed in the contract to have that interest rate bonus in the future. And then the final thing here, Simple Submit. Simple Submit is our electronic application, and it is available for all of our IUL products. All of our, I should say, individual IUL products for use with your client. So it makes it a lot easier, and Simple Submit is a lot quicker from submission to commission. So if you're looking to get paid quicker, using the electronic app is really a great way to do that. It actually is priced out or proven to be 2 weeks quicker from submission to commission than a paper application. So anyway, available on all our fixed or IUL products in the individual marketplace. And those products are the Builder, Guarantee Builder, and Rapid Builder. We also have a survivorship product in the IUL chassis, but that one currently is not available in the Simple Submit. So quickly talking about where these products fit in the marketplace, the Builder IUL is our product that you would use for future cash value accumulation / distribution. So if you're looking for college funding needs, for future unidentified needs, or for retirement planning, the Builder IUL is probably going to be your product of choice. Guarantee Builder, now this is, if you're familiar with selling term products and GUL products, you're probably going to be looking at something that's a fairly simple, straightforward sale. If you want them, the next time you're running a GUL sale, run 1 second illustration on the Guarantee Builder. And I'm going to tell you why. Because the GUL products are designed to have the zero cash value. Do we always know what our clients' needs are going to be in the future? Answer is probably no, we really don't. The client may think that the GUL is the best product for them for their future needs, but they're really not sure. They think, yeah, I want to guarantee this coverage for my entire lifetime, and I don't really care if there's any cash value in there. But if we look at the Guarantee Builder IUL, the Guarantee Builder is a product that not only has guaranteed death benefit, but it also has the IUL crediting of cash value. So you actually have the opportunity to not only have the guaranteed benefit, but you also have some significant opportunity for cash value growth. So you'd think that the premium is going to be significantly higher between a GUL and a Guarantee Builder. And the fact of the matter is it's not. In fact, the higher, I've actually seen some where the Guarantee Builder is actually lower than a GUL, but most of the time it's just ever so slightly higher than a GUL premium. If you show that to the client and say, here's a premium that has zero cash value, here's a premium that has significant opportunity for cash value growth, which one do you think the client's going to choose? 9 times out of 10, they're probably going to pick the one that has the higher or the opportunity for cash value growth, because they don't know 20 years from now if they may need to cash out the policy or use some of that cash value. So anyway, next time you're running a GUL sale, think of running a second illustration using the Guarantee Builder IUL, and I think you'll be pleasantly surprised at the type of cash value that the client can have, and it'll generate a higher premium for you, or excuse me, a higher commission for you than you're going to get with the GUL sale too. So twofold reason to take a look at the Guarantee Builder. The third product is the Rapid Builder. Rapid Builder is a great product for use in scenarios where you have you need strong early cash value growth, or you have a situation where you don't want the client to go through another 10 or 15 year surrender charge period, because the Rapid Builder has a optional rider called the Waiver of Surrender Charge option, which allows you to throw the surrender charges out and basically have your account value and your surrender value be one and the same, even from the very first year of the contract. This is a great opportunity to use in the business marketplace. Rapid Builder is an awesome product for the business marketplace because we're not impacting the business's balance sheet by using a Rapid Builder over the money just sitting in their bank account, versus most times when you're selling a life insurance product in the business sale, the only thing that the balance sheet can show is the surrender value, which if you have a surrender charge is going to be significantly lower than the account value. With the Rapid Builder, the full account value can be actually shown as a balance sheet item for the business. So great in the business marketplace. It's also good in that smart money sale I mentioned earlier, where you're actually repositioning an asset from maybe a CD or an annuity into a life insurance contract. We're going to be able to show complete liquidity for the client, so the money is very liquid and available to the client, even from the very first year of the contract. Secondarily, we're going to be able to show probably a return that's going to be competitive or even better maybe than they were getting with where the money was sitting currently, even after cost of insurance charges. And then thirdly, if they never need that money for their own purposes, that would transfer then to the next generation, their kids or their grandkids. And with the Rapid Builder, you can leverage those into much larger benefits for the next generation. So take a look at the Rapid Builder if you have a scenario like that where some client's sitting on some emergency money that they're holding off into a CD or an annuity. If they're healthy enough to apply for life insurance, the Rapid Builder and the Smart Money Sale is a win-win-win for that particular client. The last product I'm not going to spend really much time on is the survivorship. It's where we're insuring 2 lives on 1 policy. Could be a very good opportunity to show a husband and wife great cash value accumulation because the cost of insurance charges are very low in a survivorship. But again, I'm not going to spend a lot of time talking about that. Anyway, let's talk about sales concepts really quickly before we end the call here today. we have a whole host of sales concepts that are built around our product designs. And again, you see the main ones there, the retirement planning, college funding, legacy building. There's the business sales of buy, sell, key man, and executive bonus. There's a lot of other opportunities for you to utilize the North American products with your clients. And we not only have these sales concepts that fit in nicely with our products, we have sales concept kits. And these kits are available to you, obviously free of charge. If you want to go to the North American website and order them, in each sales concept kit, you get a agent marketing guide that walks you through the concept. It gives you client brochures. It gives you case studies to share with your clients. It also gives you fact finders, things that you can utilize as you're sitting down with your clients to ask the right questions so you can build the best case for that client. But again, these sales concept kits are available to you as a benefit from North American. And just, again, reach out to your Gordon Marketing marketer and ask for the North American concept kits on the areas that you would be most interested in with your clients. Anyway, so let's do a quick summary here. We talked about the definition of indexed universal life, why it's a little different than the traditional fixed products that we're maybe all used to. We talked about IUL product features and what makes an IUL tick. And then we talked about the North American IULs and where our product stands out in the marketplace and the different sales concepts that wrap around our products. And again, I think it all creates a very compelling way for you to present this to your clients. So the client gets basically a different option for life insurance in a product chassis. They get a potential for some higher returns. They get a lot of great features and accelerated benefits and things like that that maybe they didn't have in their existing plan of insurance. What do you get? You as an agent, you get potential for some new sales, great products to choose from, and a lot of support not only from your Gordon Marketing marketer, but also from the North American products and concept kits. So again, reach out to your Gordon Marketing marketer, get the materials that you need, then identify 3 clients who you think need life insurance and are a prime candidate for index products. Give them a call by the end of the week, and then position the North American IUL as that solution for your client's insurance needs. Again, there's the Gordon Marketing number there up on the screen. Hopefully everybody had a chance to garner some additional knowledge about index products and specifically the North American products and how you can utilize those when you're talking to your clients. And again, utilize those sales concept kits because I think they're a valuable tool in helping you to present these more advanced concepts to your clients. And again, generates additional revenue for you in additional clients and additional because it's probably going to be a higher target premium on these sales as well. So again, I thank everyone for joining us today. I'm going to take a quick peek here at the screen to see if there's any questions. I don't see anything popping up there. So again, I do appreciate everyone spending some time with us today. If you do have questions, reach out to your Gordon Marketing Life representative, and they can answer any questions that you might have. And we'll look forward to being on a future webinar with you and share some additional ideas with you. Thanks, everyone, and have a great day.
Thank you so much, Aller, on behalf of myself and Tim and the whole gang here at Gordon Marketing. We appreciate you taking the time out of your morning to be with us. All right, guys, so Friday's webinar, the national conference call, will feature Jennifer Green from Montana as our agent who is making it happen. Look forward to being on the call with all of you. Have a great day, and we'll meet again on Friday. Thanks.